Think about the last time you paid for something digitally. Maybe you called a car with an app, you hopped out, and the payment just happened. It settled automatically before you even closed the door.
Or you were buying something online, and right there at the checkout, a single click let you apply for a payment plan.
Mhm.
No new websites, no redirect.
Exactly. It just dissolves into the
Yeah.
background. And that invisibility is what we're getting into in today's deep dive. We're talking about embedded finance.
Yeah, it's this quiet but absolutely massive restructuring of how money moves.
So can you give us the formal definition? What exactly is it?
So embedded finance is the seamless integration of financial services. We're talking payments, lending, insurance, even core banking directly into a non-financial company's platform.
Right at the point of need.
Precisely.
Yeah.
The bank doesn't live in a separate app anymore. The bank comes to you. Did the point of sale, the point of service, wherever you are.
And our mission today is to really unpack this. We need to understand the engine behind it, which is something called banking as a service, or BOSS.
Mm.
Then we'll look at the real-world applications that are already changing how you manage your money. And this is crucial. We have to talk about the risks. The big operational and regulatory risks that come up when you start, pulling the financial system apart like this.
And we just have to start with the scale of this thing. The numbers are staggering. Projections suggest embedded finance could manage over $7 trillion in transaction value,
And that's just in the U.S.
just in the U.S. by 2026. Globally, the market is expected to jump from about $111 billion this year to over $613 billion by 2030. This isn't some niche trend. It's the new infrastructure.
$7 trillion. That's a number that just makes you pause. And you have to wonder what's driving it. Is it just taking money from old banks, or is it something more?
It's pure consumer expectation. At the end of the day, we're just used to digital convenience everywhere else, instant messaging, on-demand streaming.
So we demand it from our finances, too.
Exactly. If an e-commerce site can offer me a better, faster loan than my own bank, I'm taking it. The brand that embeds the service wins that moment.
Okay, so let's unpack the mechanics. If I run, say, a big software platform for supply chains, I don't have a banking license. How can I suddenly offer my clients working capital loans?
Right.
You mentioned the secret sauce. Banking as a service. BOSS.
BOSS is the foundation. A traditional bank is, a single vertically integrated thing. They have the charter, the deposits, the tech, the customer relationship, all in one building, so to speak. BOSS basically unbundles all of that. It takes the core functions, accounts, transfers, compliance checks, and serves them up as modular services that anyone can plug into via software.
So the bank provides the regulatory cover and the money.
Yeah.
But what's in it for them? Why would they basically outsource their main business?
It's a huge shift in their business model. For the bank, it's a move away from just making money on interest, the spread between loans and deposits.
To something more like a tech company.
Exactly. It becomes a more stable, fee-driven, SaaS-like model. The bank processes the transaction, handles the compliance nightmare, and gets a consistent fee for it, all without having to build the slick front-end app themselves.
This sounds a lot like open banking, which we heard so much about, especially out of Europe. What's the real difference here?
It's the evolution from just sharing data to actually accessing functions. Open banking, which was pushed by regulations like PSD2 in Europe, was mainly about data.
Giving consumers control of their own information.
Right. It forced banks to let third parties see your account data if you gave permission. It was about transparency.
So we went from open data to open functions.
Precisely. BOSS isn't just about seeing the balance. It's about performing the action moving money, opening an account, issuing a card all without ever leaving the partner's app. That's why you don't need the license. You're just borrowing the banks.
And the technology that makes this possible has to be bulletproof. APIs are the standard, but for finance, we can't just call them digital bridges, can we?
No, it's much more than that. In finance, an API is a secure, codified legal agreement. You need incredible security things like tokenization for data, O 2.0 for authorization. And with payments happening instantly, you need real-time fraud monitoring built right into that API layer. It has to be fast, but legally, it has to be perfect.
And all of that has to scale globally in a heartbeat.
And that's where the cloud comes in. It's just not negotiable. The cloud gives you that elastic scale to handle huge spikes in transactions like on a Black Friday without building a physical server farm. Plus, there are now really strict regulatory rules around cloud use for finance data residency, system resilience, things legacy systems just can't do.
Okay, so we've got the architecture down. Let's talk about the experience. This is where it gets really interesting for those of us, the real-world examples.
Yeah, and we can kind of group them into four main areas right now.
Let's start with the one everyone's seen.
Yeah.
Embedded payments.
Right. These are the transactions that just disappear. It's more than just your Uber ride. Think about digital wallets built into huge marketplaces like NoonPay in the Middle East. They let you manage loyalty points and get instant credit right in the app.
Or even subscription renewals, right?
Absolutely. When your Netflix payment fails, they can handle it all in the background now, reducing churn without you having to do a thing.
Next up, embedded lending. This seems like the one that gives brands the biggest immediate boost.
Oh, for sure. On the consumer side, you've got buy now, pay later everywhere. It turns a big purchase into small payments instantly. But the real story is in business lending.
You mean platforms offering loans based on their own data?
Exactly. The accounting software you use every day, it sees your revenue. It can offer you a working capital loan that's faster and better tailored than what your bank can offer because it's based on real-time data. It's contextual lending.
Then there's embedded banking, which is where things get really blurry.
Yeah, this is deep integration. The Apple Card in the iPhone wallet is the classic example. It's a full financial product rewards, spending analysis, debt management, right where you live, on your phone.
For businesses.
We're seeing e-commerce platforms offer their merchants integrated business checking accounts. So your payment processing, your inventory loans, and your daily banking all live in one single place.
And finally, embedded insurance. That little checkbox you see before you buy something.
That's the simplest form, but it's so effective. Offering travel insurance when you book a flight, or even protection for a single expensive package at checkout. It's peace of mind for the customer.
And another revenue stream for the brand.
A high-margin one, at that.
So if you pull this all together, what's the real win-win? I mean, how does a brand really get a competitive edge here, beyond just adding a feature?
The edge comes from what's called zero, or near zero, customer acquisition cost. Think about it. Shopify or Apple, they aren't spending marketing dollars to find a financial customer.
The customer's already there.
The customer is already there, using the main service. They just offer a perfectly relevant financial product at the exact moment of need. That means new revenue, incredible customer loyalty, and valuable data that makes their core business that much harder for a traditional bank to compete with.
But the second you start disaggregating finance like this, splitting it across a platform, a BaaS provider, a bank, you introduce some really complex systemic risks.
Yeah.
We have to talk about that fragility.
The central, almost existential issue here is the accountability gap. The model works because of, well, a kind of regulatory arbitrage. The fintech operates under the bank's charter. But when something breaks,
Who's actually responsible?
it's incredibly dispersed,
Yeah.
and the incentives are all misaligned. The fintech wants rapid growth. The BaaS provider wants to scale their tech, and the partner bank, under pressure to generate fee income, might not do enough due diligence on their partner's compliance systems.
So the risk gets spread out, but the final legal liability doesn't.
Exactly. The licensed bank is the one who ultimately answers to the regulator. They hold all the legal burden.
And this wasn't just a theoretical problem. It blew up spectacularly with the collapse of the BaaS provider Synapse. That was a huge warning shot.
It was a disaster. The Synapse failure really showed the danger of what are called FBO, or for benefit of accounts.
How does that work?
The partner bank holds one giant account for the benefit of all the fintech's individual users. The bank is trusting the fintech to keep the internal list, the sub-ledger of who owns what, perfectly accurate.
And when Synapse collapsed,
Thousands of people lost access to their money because nobody could agree on whose subledger was right or who was operationally responsible for giving the money back. It was chaos.
it sounds like a tech failure inside a regulatory nightmare. I can't imagine regulators are having an easy time applying old rules to this new three-party model.
They're struggling. I mean, regulators like the OCC or the Fed, they're designed to oversee single integrated banks. Now they have to enforce rules on these non-bank tech companies they don't even charter. It all falls under third-party risk management, which is just incredibly hard to police.
And that ambiguity has real costs for the companies involved
Oh, absolutely. The Chime example in the US is a great case study. They got into hot water not for losing money, but for their marketing.
because they call themselves a bank. Yeah.
They successfully marketed themselves as a bank, but they didn't make it clear enough that they were a service built on top of licensed partners like the Bancorp Bank and Stride Bank. It led to expensive rebranding, legal fees, and reputational damage, all just to clarify their structure.
So for the banks holding the licenses,
Yeah.
what are the main compliance landmines they're on the hook for?
Everything. The Bank Secrecy Act, anti-money laundering or AML controls, know your customer protocols, operational risk. If a fintech partner has a security breach that leads to a massive money laundering incident,
The licensed bank takes the fall.
the licensed bank takes a regulatory hit.
And what about the brands themselves, the Ubers? They get the loyalty, but what are the big drawbacks for them?
Well, beyond the massive technical challenge of integration, they're taking on a huge amount of partner risk. If their boss provider fails, the brand's reputation is the first thing to go, even if their own systems were perfect. And for consumers, it's confusing. If a payment fails, who do you call? The app, the tech provider, the bank. It's often not clear.
The stakes are clearly high, but this growth feels irreversible.
Mm.
So if you're a founder or an investor in this space, how do you move forward? How do you balance this incredible innovation with, being resilient?
The growth at all costs mindset is dead. It's completely over in this space. Since the market corrections in 2022, investors are so much more rigorous. They're focused on operational discipline, a clear path to profit.
And you can see that in the numbers, right?
Absolutely. The data shows that nearly 80% of fintechs improved their EBITDA margins after that correction. They cut the fat and focused on building sustainable businesses.
So an investor isn't just looking at the user growth chart anymore. They have to audit the entire architecture.
Exactly right. Due diligence now means assessing the whole value chain. You have to vet the partner bank. Do they have a clean compliance record? You audit the middleware provider's internal security. You're looking for proof of resilience, for disaster recovery plans. You have to check that the entire house is built on a solid foundation, not just that the front door looks nice.
So where's the smart money going right now in this ecosystem?
It's flowing into three key areas. First, embedded payments. It's still the biggest piece of the pie. Second, embedded lending, which is the fastest growing part because it's solving that huge unmet need for small business financing.
And the third?
The picks and shovels, the foundational tech, reg tech, and cybersecurity. These are the tools that reduce risk and ensure compliance, and you just can't scale safely without them.
And for founders trying to build a business here, what are the key strategies?
First, they have to get the economics right. They need to figure out sustainable pricing. That means things like subscription fees on top of usage fees, tiered services, revenue sharing models that actually work for the bank, the buys provider, and themselves.
And to get to market quickly, they can't build everything themselves. How do they avoid getting locked into one vendor?
That leads to the open source imperative. Using open source tech like Apache Fineract for core banking or the Open Bank project for APIs lets you innovate faster without being chained to a single proprietary vendor. It gives you flexibility and better security through community review.
It sounds like the industry realized that first model created that dangerous accountability gap, and now they're trying to design a solution.
That's the most hopeful trend we're seeing, the rise of what you could call integrated compliance models. The big provider takes on the full legal and operational responsibility themselves. They offer a compliance shield to their partners.
So they move the liability to the entity that's actually best equipped to handle it.
Exactly, and that, in the long run, is what will build trust in the entire ecosystem. So, what does this all really mean for you? Look, embedded finance isn't just a new feature. It's an irreversible generational shift in how financial services get delivered. For any business that wants customer loyalty and growth, participating in this is becoming an imperative. It's not really an option anymore.
Financial services are becoming less and less visible, but at the same time, they're becoming exponentially more powerful. The real goal here, and what makes it all so compelling, is that you never have to stop what you're doing, whether that's booking a trip or running your business, just to go deal with your money.
Your financial toolkit is just everywhere.
It's everywhere you need it. So the question isn't if you're going to encounter embedded finance, but how you can use this understanding to navigate a financial world that you can't even see anymore. And maybe let's leave you with this final thought to consider. If non-financial companies can now handle all of your essential financial needs, payments, loans, checking accounts, using better technology, and with zero cost to acquire you as a customer, What unique, essential role is left for the traditional big-name bank to play in the next decade? What is the one thing they still control that can't be embedded somewhere else?